Wouldn't it be nice if you knew when a trade was about to turn against you? Well, maybe you can. MSCI has just put together a four-pronged scorecard that it says can help you determine when a position is overcrowded. And quite frankly, there's a group of stocks that don't look so good. But before we get to that, Mehmet Bayraktar, MSCI head of equity research, is here to explain how this system that he developed works. Mehmet, great to have you on. So how do identify an overcrowded trade?
Thanks for having me. Crowding risk is indeed on the top of the minds of our clients right now. At MSCI, we have been working on identifying crowded trades, and with the crowding scorecard, we have nailed it down to four important measures. The first of these measures is mutual fund trading activity. Mutual fund trades at times can be predictors or leading indicators of crowded trades.
So what is this chart showing me?
So here what you can see is the early 2009 period when the momentum strategy experienced a historical drawdown. What we're seeing is that by looking at mutual fund trading activity, mutual fund managers were actually sellers of momentum before the momentum strategies crash.
So that's a good thing. You want to follow mutual funds.
That's a good thing.
So they give you this, they telegraph a little bit what's going to happen in the future, in other words.
Well, you have to kind of dissect it from their filings, public filings,
right,
their
with
holdings,
the
and trading activity. But once you go through that exercise, you're able to identify their trading patterns and get a leading indicator of what the future trades are going to go.
Can I just get a little primer on this? Because what is a crowd? How do you describe a crowded trade, and why would an investor not want to be in a crowded trade?
Well, the crowded trade is basically large pools of capital following the same or a similar strategy. It's not necessarily a bad thing, and this is where we've really come up with the scorecard. The most important thing is really identifying the asset price implications of this trading activity. So with the scorecard, we're combining the trading information with the asset prices and valuations to identify crowded trades.
Hence the use not only of mutual fund tracking, but hedge fund tracking, right? That's the second chart we want to show people.
Exactly. On the trading activity side, we have mutual fund trades together with hedge fund trades, very similar to what we have seen with mutual fund trading activity, with hedge fund trading activity also. Before the momentum strategy crashed in early 2009, hedge fund managers were also sellers of momentum. In fact, they started selling momentum before mutual fund managers, so they were even a more leading indicator of
So just pull that chart up again for a second, if you could. What does this chart tell you?
The chart basically shows you the short interest. So since we don't have the mutual fund holdings data to firsthand observe their trading activity, we're examining changes in their short interest patterns. And we're looking at the negative momentum stocks and the changes in short interest for negative momentum stocks. So when hedge fund managers are covering their shorts, as it relates to negative momentum stocks, it means that they're getting out of momentum.
Right. Right, they're getting out of those shorts in order to take advantage of what they perceive to be future market moves.
Exactly.
Yeah.
All right, so you got the mutual. You're sort of looking into the world of mutual funds. They give you a clue. You're looking into the world of hedge funds. They give you an even better clue because they're even earlier. What about the third group?
Well, the first two is really not enough to identify crowded trades. If you actually aggregate all of the trading activity in the marketplace, all the buys and sells cancel out. There's always a seller for a buyer for a seller. So what we really need to look at is the price impact or impact on asset prices and valuations of this trading activity. So there are two measures on that front that are price-based. The first one is pairwise correlations.
What is a pairwise correlation?
It's really the average correlation among the securities that are in a strategy. As large pools of capital, again, flow into a strategy, then what tends to happen is the correlations of those securities that are in the strategy go up or increase significantly. So by monitoring...
Meaning they become more correlated, right? Because obviously more money chases more money, and then you end up really just chasing the money rather than the investment itself.
Exactly, and you put it better than I did. And so by monitoring the trends in pairwise correlations, we're able to identify potentially crowded trades.
Okay, and just finally, the valuation dispersion.
Valuation is the final measure and perhaps the most important measure. So this is really a measure that puts it all together into the valuation space. Here we're looking at the valuation spread or the valuation of the securities that are in the strategy. And we're specifically focused on leverage here. So the valuation spread between highly levered firms versus low levered firms. You can see the great financial crisis, the 2008 crisis, where
I would say of the 4 scorecards, this one makes the most sense to me.
Yes.
If we run through all 4 scorecards, give us an example of a stock or a trade out there that is overcrowded.
Well, if you look at this chart, actually, so after the big spike and follow it through the most recent period, what you find is that the spreads are historically low levels between highly levered firms and low levered firms. Highly levered firms have been really benefiting.
Give me an example of an overcrowded trade that you have identified with these scorecards.
It's really the highly levered firms in the U.S. equity market currently. But by looking at the mutual fund manager, the trading patterns, pairwise correlation valuations, we've identified that highly levered firms against low levered firms
Can you name a couple?
are overpriced. We don't have the list of names, but we do produce the analysis.
That's an email thing between you later.
Call Mehmet.
All right?
Sure.
Mehmet Bayraktar
Call Mehmet,
of MSCI. Thank you so much for joining us this
Thank
morning.
you.